One of the hardest parts of getting closer to retirement isn't market risk. It's changing how you think about investing. For most of my life, the rule was simple: grow the portfolio, ignore the noise, don't touch anything. But once retirement gets closer, that mindset starts to work against you, and letting go of it is surprisingly uncomfortable. In this video, I want to talk about why moving from growth to income feels so wrong, even when it's the right thing to do. If you're still accumulating, growth investing makes a lot of sense. You have time, you have a salary, and volatility is just something you ride through. But when work income becomes uncertain, or when retirement moves from someday to soon, the rules start to change. At that point, investing is no longer just about maximizing returns. It's about funding your life without being forced to sell at the wrong time. Growth investing feels clean. You buy broad market funds, reinvest everything, and tell yourself you won't need the money for decades. There's also a psychological comfort in not touching your portfolio. You're not doing anything, which makes it feel disciplined and rational. The problem is that this mindset assumes you'll always have external income to support you. The moment you start thinking about income, everything feels messier. You worry about lower returns. You worry about opportunity cost. You worry that you're somehow sabotaging long-term growth. And there's a deeper fear underneath all of that. Once you start relying on your portfolio for income, you can't pretend anymore that it's untouchable. That psychological shift is much harder than most people expect. What I've realized is that this isn't really a debate about dividends versus growth. It's about dependence. When your lifestyle depends on your portfolio, volatility stops being theoretical. A 30% drawdown doesn't just mean a bad year. It can mean selling assets at the worst possible time. And that's where income stability and diversification starts to matter more than squeezing out maximum returns. For me, the shift started when I accepted that my job may not last forever and that my portfolio might need to step in earlier than planned. That forced me to ask different questions, such as how much income can my portfolio reasonably produce? How stable is that income during market stress? And how do I avoid being forced into bad decisions if markets are down early in retirement? Those questions naturally push you towards a more balanced approach, not abandoning growth, but not relying on it exclusively either. This isn't about flipping a switch from growth to income overnight. It's about gradually building a portfolio that can do two things at the same time: grow enough to protect against inflation, while producing enough income to reduce the need for selling assets at bad moments. It's a compromise. And for people nearing retirement, compromises are often what keeps plans intact. In future videos, I'll go into specifics, how I think about income, dividends, bonds, and partial drawdown. But the most important takeaway here is this: if you're starting to feel uneasy about relying purely on growth, that doesn't mean you're doing something wrong. It usually means you're adjusting to a new phase, one where resilience matters more than optimization. If you're going through a similar transition, you're not alone, even if it sometimes feels that way. If you found this useful, consider subscribing. In the next video, I'll talk about dividends versus selling shares and why this debate misses the point for most retirees. Have a wonderful day and see you in the next video.